Mr. Wallach, I'm wondering if you could just describe for us what are some of the steps that the Chinese government has already taken to try to stem the losses on the stock exchange?
Yes, good morning, and thank you for having me on the show. Yes, the Chinese government has clearly tried to address the decline in the A-share market with some measures, including rate decreases, support by brokers. They set up a $19 billion fund to purchase equities. Government agencies have been intervening in the market directly. But clearly, it's been overwhelmed by the volume and leverage in the A-share market specifically. So clearly, as you mentioned, the A-share market has declined about 25%. Although stabilizing a little bit in the last couple of days, there continues to be pressure on that market, and it's now spilling over into Hong Kong and the ADRs in the United States as well.
Right, and Hong Kong has fallen into a bear market. Gordon, I know that you are bearish on China. You've got lots of criticism about what the government has done so far, but I wonder, as China looks to introduce its next measure to support the market, what about the potential for a China devaluation of the currency? I mean, certainly the Chinese have been trying to build up credibility for their yuan internationalization, and they've held the yuan steady. Is it time perhaps to let it weaken?
You know, I think that they probably need to do that because I actually think the currency is overvalued now. When you start looking at all the money that has come out of China in the last half of last year and the first quarter of this year, the fall in the foreign exchange reserves, and also all the money that they have been spending to defend the renminbi, especially in February and March, I think that essentially you've got an overvalued currency. They're going to have to recognize that, especially when you look at their weak trade numbers. And that's really a reflection of how bad things are.
Gabriel, Wallach, do you agree with Gordon that the renminbi is overvalued?
Well, there have been outflows, but I don't agree on the currency valuation argument. That would not be necessarily a solution for China. I would like to point out that this correction in the market is related more to overvaluation of equities and leverage in the market. It is not necessarily an indicator of future growth for earnings or for the economy. The economy has slowed, and it will be very interesting to see in the second quarter how companies are performing. Interestingly, banks have been very defensive in this market, and the reason for that is their balance sheets are actually better today, 5 years after the crisis in 2008 and 2009. So the issue is not really an overvaluation of the currency. Interest rates are coming down, clearly, dramatically, and very quickly. And let me point out another issue, which is really we're in the middle of a credit crisis globally. And you can see that with sovereigns like Greece coming back to the headlines. But you can also see it at the corporate level in the high-yield market across emerging markets, whether it's an energy company in Brazil or property companies in China, which have overextended themselves over the last couple of years.
Right. So
and as you see rates rise globally or easing, such as QE end, that will become more difficult for companies that need to refinance.
Right, so that safe haven move is certainly one factor as well. Gordon, China's surprise weekend interest rate cut in late June was accompanied by a reserve ratio requirement reduction as well. That's the first time it's happened simultaneously. Is your take on this similar to Gabriel's, where we've got a risk-off environment around the world, or is it specific to China that it needs to do what it can to prop up its economy?
Yeah, this is really China-specific. And what's really interesting, you know, we've had 4 reductions in the benchmark interest rate since November. We've had 3 reductions in the reserve requirement ratio since February, and it's had very little effect. You know, monetary stimulus right now in China really has, you know, they can reduce interest rates all they want, but the real problem is there's a fundamental lack of demand. And, you know, when we look at this bubble was created by the central government by talking it up. And they've been doing this now for about 9 months, and they've now owned what it basically is a stock market crash. This is extremely serious because basically you've got people in China now starting to blame the Communist Party for what's going on.
Gordon, can you speak a little bit about the credibility of Chinese leaders? Is this a political issue now?
This has become extremely political. The announcement of the rescue package on Saturday, clearly it's directed towards the blue chips, which means that it's supposed to help people in Beijing, you know, and then really what you've got now are individual investors around the country are saying, well, what about me? Why aren't you rescuing the small caps where I'm invested in? And basically right now, the conversation in Hong Kong, where I am, is that Chinese leaders are panicking. They're terribly bungling this rescue package, and essentially they've lost all credibility. So this is a situation where even if they try to do something now, I think that they're going to have problems, because especially today, when you had across-the-board falls in three major indices, it's an indication that people no longer trust Premier Li Keqiang. And we're going to probably see some changes in the political system as some people are axed.
All right, that's certainly one point of view on this. Gabriel, as someone who's in the markets, as a foreign investor, you've got to look at the support measures that are being introduced on what seems like a daily basis. You now have companies themselves taking matters into their own hands by suspending trading. According to Bloomberg data, 745 companies have now halted trading in their shares, equivalent to 26% of listed firms in China. Most of these halts are by Shenzhen-listed companies. This is not confidence-inspiring for a foreign investor. Where is the price discovery?
Yeah, no, you're absolutely right. And again, this the overvaluation of the local markets, whether it was Shenzhen or Shanghai, was clearly a problem. Which, when the link was introduced, we assumed the arbitrage would take place between Hong Kong and the Shanghai shares that had a premium. Now, the two alternatives is, one, Hong Kong shares rise as flows come south, or Shanghai shares decline as the arbitrage comes lower. And of course, that's what's occurred. So I think it's more of a natural situation for A shares to reduce their premium. This is not necessarily related to fundamentals. Having said that, you're right. The measures are not going to work, in my opinion. They're too little to support the market. I don't think they should be implemented, whether it's share buybacks or, as I mentioned, the intervention by brokers in the market. It is not the role of the government. In fact, the opening of the capital account, the opening of the link, suggests that the authorities in China want to increase flows and use market alternatives rather than intervening in the market.
Gotcha.
So I do think this is the A-share market has always traded at a premium. We expect that premium to decline as the link is utilized.